picking a good business is way, way, way more important than being good at business. And it's easy for me to get arrogant and cocky and think, oh my God, I'm so good. I'm so good at what I'm doing with self-storage. Everybody who bought a storage facility a year ago or 2 years ago or 6 months ago is doing really, really well. Hello, hello, hello. In this episode, I'm going to do 3 things. I'm going to tell you what keeps me up at night. I'm going to give you an update on my portfolio. And I'm going to break down the Q3 REIT self-storage earnings calls, which we found out from, basically we heard from Public Storage, Extra Space Storage, Life Storage, and CubeSmart, how well they did in Q3. Now, first, what keeps me up at night? Now, you may not realize this, but in the great financial crisis, you know that a lot of real estate investors went bankrupt. They ran out of money. You may not understand exactly how it all went down. And you might think, oh, they were over leveraged. Their debt service got too large. They had no cash flow. They could not do anything about it. Well, that's not true. Over 90% of real estate bankruptcies, over 90% of the people who go bankrupt while investing in real estate, it happens when one of their loans mature, meaning it reaches the end of its term and the bank no longer has the obligation to continue servicing that loan. In housing, in a lot of multifamily and also residential mortgages, you have 30-year, 20-year, 25-year, 15-year fixed rate mortgages. The loan's the same, the payment's the same, the interest is the same for the entire duration of the loan. Now that's pretty darn rare in commercial real estate. Me, self-storage, we have 3-year term and 5-year term loans. When you start out, you start with bridge loans, meaning this loan is in place for 3 years. This loan is in place for 5 years. Usually there's language of what happens afterwards, but most investors don't realize that the bank is no longer obligated to service your loan. They can tell you, hey, you need to go refinance this loan. And if you can't, guess what? We're going to take it. So what happened in 2008, 2009 was many, many investors were reaching the end. Their loans were maturing. They were ballooning. They were the end of the term. The banks no longer wanted to service them. So what did? They called their loans. So most of the bankruptcies did not happen because an investor didn't have the cash flow to service a loan. Most of them did have the cash flow. Most of them could have continued to make the same debt service payments that they were making at the time. What happened was their loans matured. Their loans reached that point in time where, hey, it's time to go get different debt. And what do I mean by different debt? What do I mean by this entire environment where why do our local bankers only want to hold on to a loan for so long? Let me tell you why. We work with a big bank out of Ohio with a location in Rochester. It's Key Bank, actually, great bank. They don't want our loans on their books for a long time. They don't want it. They want to place it in the capital markets or get some kind of long-term debt or allow us to sell our assets or whatever it might be. They're looking at this as bridge financing. Bridge financing, meaning we don't want it on our balance sheet long-term, but we're going to make you the loan on your balance sheet now. You're going to add value to the property, and then you're going to figure something else out. And that's what happens most of the time. So they want us to come in, make the property more valuable, and then sell it. So what happens when a guy like me, when I look at the risk, when I look at what keeps me up at night, when I look at what makes me the most nervous? It is definitely the fact that if I look at my portfolio, pulling it up right now, if I look at my portfolio, I have over $40 million of bridge short-term floating debt. The interest rate on some of these loans, where I'm adding a lot of value quick, is literally $49 million of loans, and none of it is fixed. Not all of it floats. Most of it is a 3 to 5 year term, but a lot of it is a 3-year term. And it's floating, meaning every single month, the interest rate actually adjusts on Wall Street Journal Prime. So it's Wall Street Journal Prime plus X, and that's our rate. And if Wall Street Journal Prime starts to go up, our rate starts to change. Now, an interest rate change we can handle. Our debt yield across our portfolio is well north of 13%. We have a ton of strong cash flow. We can support higher interest rates, but what we can't support is getting to the end of these 3-year debt terms and being stuck and not being able to refinance and having to come up with $49 million to pay back the bank. That is how people go broke. So what I am doing now is working on a recap from some properties we bought a year and a half ago. Buy them a year and a half ago, make them a lot more valuable, and then recapitalize them. Put long-term debt on. Give your investors an opportunity to get bought out. I'm working on that right now. I'm excited to, heck it, I'll give you the details right now. Recap plan. We had 4 different properties. Me and Dan bought 2 of them on our own. 3 in Pennsylvania, 1 in Ohio. 2 we bought in October 2019. So exactly 2 years ago. 1 in December 2020 and 1 in February of this year. So the most recent 2 are pretty new. Our original cost basis on all 4 properties, $3.4 million. If you value them today at a 6 cap, they're worth $8.3 million. So from 3.4 to 8.3, a lot more valuable. Get about 65% debt on it, about 5.2 million. We're looking at CMBS debt, which means commercial mortgage-backed securities. They actually sell them on the open market, which interest only, non-personally guaranteed CMBS debt is the nirvana of debt. People love it. People hate it as well because there's a lot of hoops to jump through, a lot of reporting, and you're stuck with it. The defeasance, the prepayment penalties on CMBS loans are very, very high, expensive. Basically, all the interest that you owe for the rest of the term, basically you have to pay if you defease on the loan. But we're going to recap it. We're going to bring together new partners, put long-term debt on, move it off our books so that we no longer have floating debt on those assets. Boom, baby. Awesome. Great, right? Okay, now let's talk about a couple other things. Number one is, over 90% of real estate bankruptcies come from a loan reaching the end of its term. That's scary stuff. My situation, how has my life changed over the past 2 years? And I actually did a talk at a conference, my first talk where I had to go up on stage in front of 250 people by myself instead of getting interviewed at Reconvene Moses's conference out in LA. I got interviewed. Easy, right? Easier. You don't have to have an agenda. The interviewer really had to have, their stuff together when they were interviewing me. But I had to go up there and give a talk. So I said, oh my gosh, how has Twitter changed my life? That was the goal to talk. How has Twitter changed my life over the past year? 2 years. So I looked back to my life 2 years ago. 2 years ago, we had a service company that was not that successful, worth about $1 million. We had $4.06 million worth of self-storage that we had acquired. Our initial property for 2.9 and 5 other very small properties for a total of 86,000 rentable square feet, 886 units, and we had 1 designated full-time employee for self-storage. That was me. No other team. We did utilize some resources from our other company, but there was no other team, nothing else really going on. 1 employee. And the value of our assets, even though we bought them for $4.06 million, was about $10 to $11 million. That's where we were 2 years ago. You fast forward to today, $74 million of self-storage that we've acquired, $24 million in outside capital raised. And by the way, 2 years ago, we were at $500K in outside capital raised. I had to fight tooth and nail to raise that money. We have 44 properties, and this actually counts what we will have by the end of this year. This is the stuff that we're going to be closing on by the end of this year, nothing into 2022. 44 properties, 1.2 million square feet of storage, which puts us in the top 20 private operators in the country, not by capital deployed. There's been many others that own more than 130 million worth of storage, but by square footage. Again, we're buying, our average basis is about $60 a foot, so we're buying a lot cheaper than most operators. 1.2 million square feet of storage, 8,985 units, 31 full-time employees, of which we run a real estate private equity company, we run a management company, and a value of our portfolio, which I don't try to put too much weight in, but a value north of $130 million. That is how my life has been impacted in the past 2 years. One of the podcasts soon, I'm going to elaborate on that and tell you more about what I have going on. But lastly, I want to analyze the self-storage Q3 earnings calls. Shout out to my friend, Cody Gilfillan. He's a good buddy of mine, and he's really into self-storage as I am. And he and I both kind of analyzed these calls. Here's what we're looking at. CubeSmart, Q3, same store performance included headline results of 15.6 year over year revenue growth. 15.6% year over year same store revenue growth. This is not company-wide revenue growth. This is same store, meaning one asset in its own place, not the company-wide with new acquisitions and all the different channels. This is one store as is. How much more revenue did that store generate this quarter, this year, compared to last year? 15.6%. To put it in perspective, Google, tech company, one of the fastest growing tech companies of all time, is on pace about that same, about 15% year over year revenue growth. So the expenses grew 3.9%. So expenses, which in general are much smaller, expenses make up about 40% of that revenue. Expenses grew 3.9%. Revenue grew 15.6%. That means net operating income grew 21.1% for the quarter. That is absolutely astounding. 21% profit growth year over year. Same store occupancy levels, unseasonably strong, 95%, up 150 basis points, which means 1.5%. That's insane. This is a direct quote from the CEO of CubeSmart. All of us on our side of the table and your side of the table have underestimated the strength and quality of the demand of the customer that has come here since the beginning of the pandemic. That's insanity. And I read this and I just cannot believe how lucky I am to be in this business. It is better to be lucky than good. These types of earnings will give a guy like me a big head. It'll make me think that I really know what I'm doing and that I'm such a good operator, but in reality, I'm in a good business. So based on the strong operating fundamentals we've discussed, we've increased our guidance next year, obviously. Wow. Absolutely insane. So they acquired $33 million of storage. That's not much during the quarter. We actually are going to acquire about $33 million worth of storage this quarter. So let's go on life storage. Third quarter same store revenue growth, 17.4%. That's insane. Up 14% from last quarter. External growth, they acquired. They're on pace for the year, $1.7 billion in new acquisitions. They are growing very quick. Life storage is super aggressive. 60% of our customers are still below the street rate. That means they physically cannot raise rents high enough to get them over street rate. In my portfolio, about half my customers are above street rate. They have 60% of their customers that they've been unable to raise their rents fast enough to keep up with how fast the actual street rates that they're advertising to new customers off the street are going up. Year-to-date stock performance of life storage up 63%. The boring old REITs that pay 3.5% dividends are up 63%. Extra space storage, all-time high of occupancy, 97%. Vacates continuing at lower than historic levels, and rentals reaching all-time highs. Absolutely insane. The customers are not very price sensitive, and those who are were able to backfill very, very quickly. That's a direct quote from the call. Everybody in this business is pushing rates. Our achieved rates in the third quarter were 40% above where they were in 2019. 40% above where they were in 2019. And this is with a ton of new supply coming on in these towns. I mean, Extra Space Storage, CubeSmart, Life Storage, these portfolios own self-storage in very, very high-end towns. We're talking about major metros, super busy areas, and they're still able to push revenue 40% above pre-pandemic levels. That's absolutely insane. With all this new development, all these new facilities coming on the market, they're able to drive it this fast is insane. So they issued this is very interesting. They issued $600 million of 10-year bonds, unsecured, in the name of the company at 2.35%. And again, we talk a lot about small scale. On my very first deal, we borrowed at 5%, 20-year term, interest and principal, no interest only period. Now we're getting a little bigger, a little bit more scale. We're placing more debt. We're able to borrow about 3.6%, but that's IO for only 2 years, floating debt, pretty, risky. When you go up, as you keep going up the chain and buying more and more storage and getting more and more scale, you can get cheaper and cheaper debt. And there's nowhere that this is more true with Extra Space Storage here. They issued $600 million of bonds. They sold it on the public market and they let the market decide what the interest rate should be. It came in at 2.35%. This is unsecured bonds. Their portfolio is about 20% leverage, which means, I'm at my new acquisition, I'm 60% leverage, a little bit more risk. These REITs are around 20% levered and they're borrowing at 2.35%. So you think about the cost of capital. They can pay more they can get lower yield and they're going to get better return because they're borrowing at 2.35% interest rates. That's pretty darn good. We're at 25% today for their e-rental program, meaning 25% of the people at Extra Space Storage rent online. The last call 3 months ago, they were at 20 to 21%. So very quick adoption of online rentals. That's exciting for me because all we do is online rentals. Year-to-date stock performance up 70% for Extra Space Storage. This is crazy. This is craziness. Keep saying the same thing over and over again. You guys are getting tired of hearing me say, absolutely insane. Our same store revenue, now we're going on to Public Storage, which is the most poorly managed one of the group, honestly. Same store revenue up 14%. $18 billion of assets trade they're likely to see. That was just a comment that we took away from this call. In 2021, the self-storage industry will likely see $18 billion of assets trade. That's a lot. I only need 100 million of it, which is less than 3% of the self-storage that will trade on the market next year. Here we go. Let's see. This is an exciting thing from Public Storage. Nearly 50% of their customers right now, are renting through the e-rental online lease, meaning 50% of the customers are renting online for Public Storage. I guarantee you pre-pandemic that was below 20%. More and more adoption of online. That's exciting stuff for me. The year-to-date stock performance of Public Storage up 42%. Boo, only 42% in 1 year. And that's all I got. This has been just an incredible ride. I mean, you think about trying to pick a good industry. Picking a good business is way more important than being good at business. And it's easy for me to get arrogant and cocky and think, oh my God, I'm so good. I'm so good at what I'm doing with self-storage. Everybody who bought a storage facility a year ago or 2 years ago or 6 months ago is doing really well. We're lucky. Investor money is flocking towards us. Our portfolio is doing even better than the REITs. Obviously, we're much smaller, much more unique value add prop, but it's just mind blowing. Self-storage is absolutely crushing. So I hope you enjoy this episode a little longer, and we will talk to you soon. Juniper Square, the sponsor of our show, recently did a capital raising survey. And in this survey, they asked 142 senior executives at US-based commercial real estate firms a series of questions to understand the state of commercial real estate fundraising. It's an insanely valuable report with data on questions like, how much capital did you raise last year? How long did your last raise take? What type of investors are you raising the most from? And what strategies are working the best for you to find new investors? Download this report for free at junipersquareresearch.com. That's junipersquareresearch.com. Big thank you to Juniper Square for sponsoring the show. Thank you for listening to the Nick Huber Show. Just wanted to remind you that we have a paid real estate community where some really special stuff is happening. People are breaking down deals. People are networking. People are, I think, even formulating partnerships inside this group. We have over 100 members now. For more information, you can visit sweatystartup.com/REC. And the first 299 members of the group, to get some momentum, get $200 off the annual membership using the code FIRST299, FIRST 299. And also, you can check it out for 5 days for $1. You make a $1 payment, you can check out the community for 5 days. Highly recommend it if you're serious about bringing in some other people into your network, into your life, to help you become a better real estate investor.